Hey guys, these are the best investments to make in 2020. At number 7, S&P 500 index funds. If you want to achieve higher returns more than traditional banking products, a good alternative is an S&P 500 index fund. The fund is based on the 500 largest American companies, meaning it comprises many of the most successful companies in the world. For example, Berkshire Hathaway and Walmart are the two of the most prominent member companies in the index. Like nearly any fund, an S&P 500 index fund offers immediate diversification, allowing you to own a piece of all those companies. The fund includes companies from every industry, making it more resilient than many investments. Over time, the index has returned about 10% annually. These funds can be purchased with very low expense ratios, and they are some of the best index funds to buy. An S&P index fund is an excellent choice for beginning investors because it provides broad, diversified exposure to the stock market. Risks. An S&P 500 fund is one of the least risky ways to invest in stocks because it's made up of the market's top companies. Of course, it still includes stocks, so it's going to be more volatile than bonds or any bank products. It's also not insured by the government, so you can lose money based upon fluctuations in value. However, the index has done quite well over time. Liquidity. An S&P 500 index fund is highly liquid, and investors will be able to buy or sell them on any day the market is open. At number 6, short-term corporate bond funds. Corporations sometimes raise money by issuing bonds to investors. Small investors can get exposure by buying shares of short-term corporate bond funds. Short-term bonds have an average maturity of 1 to 5 years, which make them less susceptible to interest rate fluctuations than intermediate or long-term bonds. Corporate bond funds can be an excellent choice for investors looking for cash flow, such as retirees or those who want to reduce their overall portfolio risk but still earn a return. Risks. As is the case with other bond funds, short-term corporate bond funds are not FDIC insured. Investment grade short-term bond funds often reward investors with higher returns than government and municipal bond funds. But the greater reward comes with added risk. There is always the chance that companies will have their credit rating downgraded or run into financial trouble and default on the bonds. Therefore, it is important to ensure that your fund is made up of high quality corporate bonds. Liquidity. You can buy or sell your fund shares every business day. In addition, you can usually reinvest income dividends or make additional investments at any time. Just keep in mind that capital losses are a possibility. At number 5, government bond funds. Government bond funds are mutual funds that invest in debt securities issued by the US government and its agencies. The funds invest in debt instruments such as treasury bills, treasury notes, treasury bonds, and mortgage backed securities issued by government sponsored enterprises such as Freddie Mac and Fannie Mae. These government bond funds are well suited for low risk investors. These funds can also be a good choice for beginning investors and those looking for cash flows. Risks. Funds that invest in government bond instruments are considered to be among the safest investments because the securities are backed by the full faith and credit of the US government. However, like other mutual funds, the fund itself is not government backed and is subject to risks like interest rate fluctuations and inflation. If inflation rises, purchasing power can decline. If interest rate rises, prices of existing bonds drop. And if interest rates decline, the prices of existing bonds rise. Interest rate risk is greater for long term bonds. Liquidity. Bond fund shares are highly liquid, but their values fluctuate depending on the interest rate environment. At number 4, Treasury securities. The US government issues various types of securities to raise money to pay for its projects and pay its debts. These are some of the safest investments to guarantee against loss of your principal. Treasury bills or T-bills have a maturity of 1 year or less and are not technically interest bearing. They are sold at a discount from their face value, but when they mature, the government pays you the full face value. For example, if you buy a $1,000 treasury bill for $960, you would earn $40 on your investment. Treasury notes or T notes are issued in terms of 2, 3, 5, 7, and 10 years. Holders earn fixed interest every 6 months and then face value upon maturity. The price of a T note may be greater than, less than, or equal to the face value of the note, depending on demand. If demand by investors is high, the notes will trade at a premium, which reduces investors' return. Treasury bonds or T bonds are issued with 20-year and 30-year maturities that pay interest every 6 months and face value upon maturity. They are sold at auction throughout the year. The price and yield are determined at auction. All these types of treasury securities are offered in increments of $100. Treasury securities are a better option for more advanced investors looking to reduce their risks. Risks. Treasury securities are considered virtually risk free because they are backed by the full faith and credit of the US government. You can count on getting interest and your principal back at maturity. However, the value of the securities fluctuate depending on whether interest rates are up or down. In a rising rate environment, existing bonds lose their allure because investors can get a higher return from newly issued bonds. If you try to sell your bonds before maturity, you may experience a capital loss. Treasuries are also subject to inflation pressures. If the interest rate of the security is not as high as inflation, investors lose purchasing power. As T-bills mature quickly, T-bills may be the safest treasury security investment, as the risk of holding them is not as great as with longer-term T-notes or T-bonds. Just remember, the shorter your investment, the less your security will generally return. Liquidity. All treasury securities are very liquid, but if you choose to sell prior to maturity, you may experience gains or losses depending on the interest rate environment. A T-bill is automatically redeemed at maturity, as is a T-note. When a bond matures, You can redeem it directly with the US Treasury or with a financial institution, such as a banker or broker. At number 3, money market accounts. A money market account is an FDIC insured interest bearing deposit account. Money market accounts typically earn higher interest than savings account and require higher minimum balances. As money market accounts are relatively liquid and earn higher yields, they are a greater option for your emergency savings. In exchange for better interest earnings, consumers usually have to accept more restrictions on withdrawals, such as limits on how often you can access your money. These are a great option for beginning investors who need to build up a little cash flow and set up an emergency fund. Risks. Inflation is the main threat. If inflation rates exceed the interest rate earned on the account, your purchasing power could be reduced. In addition, you could lose some or all of your principal if your account is not FDIC insured, or if you have more than the $250,000 FDIC insured maximum in any one account. Liquidity. Money market accounts are considered liquid, especially because they come with the option to write checks from the account. However, federal regulations limit withdrawals to 6 per month, of which no more than 3 can be check transactions. At number 2, certificates of deposit. Certificate of deposit or CDs are issued by the banks and generally offer higher interest rate than savings accounts. These federally insured time deposits have specific maturity dates that can range from several weeks to several years. Because these are time deposits, you cannot withdraw the money for a specified period of time without penalty. With a CD, the financial institution pays you interest at regular intervals. Once it matures, you get your original principal back plus any accrued interest. You may be able to earn up to around 1.8% APY on this type of investments as of May 2020. Because of their safety and higher payouts, CDs can be a good choice for retirees who don't need immediate income and are able to lock up their money for a little bit time. However, there are many kinds of CDs to fit your needs, and so you can still take advantage of the higher rates on CDs. Risks. CDs are considered safe investments. However, they do carry reinvestment risks. Reinvestment risks is the risk that when interest rates fall, investors will earn less when they reinvest the principal amount and interest in new CDs with lower rates. The opposite risk is that rates will rise and investors won't be able to take advantage because they have already locked up their money into a CD. It is important to consider investing money in CDs for varying terms so that all your money isn't tied up in one instrument for a long time. It's vital to note that inflation and taxes could significantly erode the purchasing power of your investment. Liquidity. CDs aren't as liquid as savings account or money market accounts because you tie up your money until the CD reaches maturity, often for months or years. It is possible to get your money sooner, but you will often pay a penalty to do so. At number 1, high yield savings account. Just like a savings account, earning pennies at a bank, high yield online savings accounts are accessible vehicles for your cash. With fewer overhead costs, you can earn much higher interest rates at online banks. As of May 2020, you can find accounts paying above 1.5% interest. A saving account is a good vehicle for those who need to access cash in the near future. Risks. The banks that offer these accounts are FDIC insured, so you don't have to worry about losing your deposit. While high yield savings accounts are considered safe investments, like CDs, you do run the risk of earning less upon reinvestment due to inflation. Liquidity. Savings accounts are about as liquid as your money gets. You can add or remove the funds at any time. Thanks for watching. If you have enjoyed this video, don't forget to drop a like below and subscribe for more upcoming videos.